Hello, everyone, and welcome to this Energy Quick Chat where we rub minds with stakeholders and players in the energy market. Oil prices appeared ready to break a 7-week streak of gains on Friday as worries about China's slowing economic growth and the potential for increased U.S. interest rates outweighed any signs of tightening oil supply. However, earlier in the week, prices fell more than 1.5% after concerns over China's economy put pressure on crude futures. Julien Mathonniere is the oil markets economist at Energy Intelligence, and he joins me now from London. You're welcome, Julien. It's good to have you join us.
A very good day to you, Justina. Thank you for having me.
Now, Julien, at first we saw that steep drop in oil prices from Monday till Wednesday, but on Thursday through till Friday, oil prices snapped back up. What are your thoughts on the volatility we saw in the oil market this week?
Well, I'd say there are two interesting things. One is that this price seems to have found an anchor at around $85 per barrel. So yes, it's going up and down, but it stayed very much, around the sort of mid 80 level. And the second thing is that if you look at the derivative market, the paper market, the time spread on the Brent futures contract is around 40 cents, more or less, also going up and down, but, staying around 40 cents. And it tells me, and traders will confirm that this market is roughly in balance. So, in a nutshell, oil prices have finally broken out of the slump from the last few months with both the demand, the macro sentiment and supply, OPEC plus cuts, helping to buoy this market. But while we are back at the higher end of the price range that we've seen in the last 6 months, we also see limits to a major price breakout. Why? One, because Brent is now trading October, which means that the current price already reflects the fourth quarter demand. Two, because, deeper cuts from Saudi Arabia and perhaps more importantly, Russian exports finally rolling over a bit in July mean that OPEC has more spare capacity, and that it can use that later in the year if it's needed. And even if it doesn't, and that's my third point, most demand can now be filled by non-OPEC supply. And we still see persistent macroeconomic risk. China economy remains a mixed bag going into 2024, which means that, demand will not exceed 1 million barrels per day in 2024. So limited price upside, more range-bound prices, and probably a bit less volatility.
I know China introduced some measures to shore up its economy during the week. So what's the trajectory for oil in the coming week based on this weak economic data we saw coming from China?
So the Chinese economy is central into the demand debate because China is supposed to deliver half of the 2 million barrels per day of demand growth that we see in 2023. And yes, the country consumer are driving and flying more since the end of the COVID-19 restriction, but the industry sputters. So the Chinese government is sort of contemplating some form of stimulus now. I mean, it's very much into the air. China's industrial activity is not looking great. If you look at producer prices, they have been falling for 10 consecutive months in a row. And the problem is that both consumer and producer prices have been contracting this time. So, China needs some kind of stimulus and stimulus on demand. A lot of China's demand so far has been precautionary oil filling storage rather than, growth-induced consumption fueling a thriving economy. And it's unclear at this point how much more crude oil China can continue to import if prices stay high or if the price continue to rise. But we expect China to slow down its crude import, which is why, that stimulus, action from Chinese central bank and government would be important.
Are we looking at $90 in the coming weeks?
We're probably looking at the same range. I don't think anything below $90 will be possible. You've got too much pressure from the spare capacity, as I said, from the macro environment. So 90 will be the peak.
So now let's bring this home. Africa. What are the implications of this rise in oil prices on Africa's emerging and frontier economies in view of the recent trends in major oil importing countries like Ghana, Kenya, and Nigeria?
Yeah, it's Africa is a very interesting region because there are two separate developments, but they both stem from the same problem, which is basically how do you deal with imported fuel inflation at home? You can only subsidize fuel as a short-term measure, which means that you must either curb demand by increasing prices to cover for the higher import costs, or you must produce your own fuels domestically. Now, Nigeria scrapped its fuel subsidy in June, and Ghana has increased fuel prices quite steeply, in both cases to curb demand growth and sort of relieve the state budget of a major burden. But Nigerian plans to replace imports with its own production. The country's massive Dangote refinery, which was inaugurated last May, could be a game changer. And then it should be joined by Ghana's Central refinery, which is also due to come on stream, I believe, in the first quarter of 2024. And Ghana is now one of the top importers of discounted Russian gas oil and diesel, which means that, they're trying to find a solution to get some cheaper, to lower the cost of their fuel import. And West African nations, Senegal, Ghana, and Cote d'Ivoire, are currently in line for 1.6 million barrels of Russian diesel import in August, which is quite significant. And sometimes higher price backfire, like in Kenya, where the government has been forced to, it's been forced by the street to basically bring back a small subsidy to stabilize retail fuel price. But, the move does not amount to a full reinstatement of subsidies. It's only for 30 days. And as I said, it's a short-term solution. Kenya will have to find another way to, fend off the fuel price problem.
Thank you so much for those insights and your perspective on the global oil markets. Julien Mathonniere, oil markets economist at Energy Intelligence. Thank you so much.
A pleasure. Thank you, Justina. Thank you for having me.
Yeah, that's it on our Energy Quick Chat this week. Thank you, everyone, for watching. I am Justina Okechukwu. Bye-bye.